Committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. This hearing is entitled Examination of the Federal Financial Regulatory System and Opportunities for Reform. Before we begin today, I'd like to thank the witnesses for appearing today. We appreciate your participation and look forward to a robust conversation. We do apologize. We do have votes scheduled this morning sometime between 10 and 10:30, so we'll recess for a period of time. If you guys want to step out and get some refreshment, grab breakfast, whatever, we will be back probably shortly thereafter, but we will have to stop for a little while and go vote. With that, I recognize myself for 5 minutes for the purposes of delivering an opening statement. Financial companies are standing on regulatory quicksand, having to constantly shift in an effort to stay afloat. There are unending attempts to decipher a regulator's wants and needs, allowing little to no foundation on which to run a business. Ultimately, this world of ambiguous guidance, contradictory rules, and aggressive enforcement has led to confusion for financial companies seeking to comply with Dodd-Frank and other Obama-era rules. But the greatest impact is on the customers of those financial companies, who in many cases have been left clamoring for access to financial services and paying more for the ones they're able to retain. Take a look at the boxes sitting on the dais. Where are they? Back over here. These boxes represent the 20 to 30,000 pages of paper that the average bank submits to the Federal Reserve for the annual CCAR review process. And in fact, I was talking to one of the larger banks last night. It can go up to 100,000 pages. That's 20 to 30,000 pages per bank per year just for CCAR. Despite the amount of information contained in these boxes, feedback from the Federal Reserve is limited, leaving some institutions to wonder who, if anyone, actually reads the material before issuing what has been described as an arbitrary, qualitative decision. You have a picture of what overregulation looks like, but allow me to provide you with a real-life example. The Mid-America Bank and Trust was originally founded in 1920 and serves communities in my area of the world in central Missouri. For nearly 5 years, the Federal Reserve has blocked acquisition of the bank. Despite years of document production, there has been little communication between the Board of Governors and bank leadership, and there is no indication of when a decision might be made as to whether or not an acquisition will be approved. Mid-America Bank and Trust has already lost several interested buyers, not because of questions surrounding the business, but instead because of the delays from the Fed. So for 5 years, the Federal Reserve has left this bank, its customers, and the communities it serves sitting in purgatory. This is all in spite of the fact that, as I understand it, the FDIC has given the institution and its products a clean bill of health. The Consumer Financial Protection Bureau hasn't exactly been a poster child for reasonable rulemaking and enforcement either. Just yesterday, members of this committee heard from Director Cordray directly. The director continues to state that the Bureau has never and would never regulate through enforcement. But as I pointed out to the director several years ago, failure to issue guidance while simultaneously subjecting institutions to enforcement actions is, in fact, regulation through enforcement. Now, because of the Bureau, people need a crystal ball to run their businesses. The CFPB rules and policies are a perfect example of Washington knows best. The federal government knows what types of financial products should be offered and to whom. Rules and enforcement actions leave little or to no room for innovation, despite the fact that American consumers and small businesses continue to struggle to get financial services they need to pursue growth and economic freedom. Once again, the consumer suffers. Eventually, one must wonder what the federal financial agencies really want: a stable economy or just more control? Today's hearing will serve to examine the state of the federal financial regulatory system and to determine what can be done to increase transparency and build a strong, steady financial system and U.S. economy. It's long past time to take the power out of Washington and return it to the American people. It's past time to demand a reasonable regulatory structure that fosters innovation and economic opportunity, while simultaneously allowing for robust consumer protection. We have a distinguished panel with us today. We look forward to your testimony and your ideas for reform. The chair now recognizes the ranking member sitting in today for the ranking member, the distinguished gentleman from Georgia, Mr. Scott. He's recognized for 5 minutes for an opening statement.
Yeah, thank you very much, Mr. Chairman. Really appreciate this. First, I want to thank Chairman Luckenmeyer, excuse me, for convening this very, very important hearing. Nothing could be more important right now than making sure we have a healthy financial system, and not just a healthy financial system, but the most healthy financial system in the world. And I look forward to our distinguished witnesses and their testimony. But you know, I don't think it would be difficult to say that any member on our committee, Democrat or Republicans, would disagree that our striking the right balance between consumer protection and regulatory burden is an important priority for this committee. We should certainly and constantly re-examine whether we are achieving this goal, and hopefully we can come to some conclusions today on that in hearing from our distinguished panel. But without any re-examination, we must always start looking at the lay of the land before us, the data we have in front of us. So why don't we take a moment to do just that? First, we are indeed experiencing record month-over-month job growth. For the past 77 consecutive months, we have seen positive gains in employment. But I hasten to add, not enough gain, and in some ways, we are backtracking when it comes to many of our urban centers. This is something we need to devote more attention to. Second, small business lending is trending upward. And since the financial crisis, we have seen nearly a 75% jump in business lending. And lastly, we are seeing our housing debt, an enormous part of our financial crisis, finally dipping back below the previous peak we saw in 2008. So things seem great, but we can make them better. But even with all these positive signs, we also are seeing some areas in the financial services world that still needs improvement. For example, I previously experienced concerns in this committee. I've expressed those concerns that some regulations might hamstring the unbanked and the underbanked family's ability to gain access to important financial services. Many of your committee, you have followed our progress with indirect auto lending. That is a prime example where some regulations certainly hamstring the unbanked family. We have 70 million unbanked and underbanked Americans in our financial system. But I really want to challenge both sides of the aisle, Democrats and Republicans, and our panelists, to begin this conversation by re-examining the whole regulatory system, not just Dodd-Frank. Dodd-Frank is an important part, but we got to look at and examine all sides of our regulatory system. I would welcome a constructive, bipartisan conversation about Dodd-Frank, but let's not forget all the ways that Dodd-Frank has improved the banking system and health of our economy, and how it helped us to come out of the worst financial depression we've had since the 1930s. So throwing it out completely, as our distinguished committee chairman, Mr. Henseling, is proposing in his Choice Act, it ignores these positive developments and is therefore a non-starter for Democrats. But we Democrats equally look forward to working with our Republican colleagues to both strengthen our financial regulatory system while simultaneously also looking and making sure our regulations do not hamper our financial system. So again, I want to thank Chairman Lukemeyer for calling this hearing, and I'm looking forward to hearing what the witnesses have to say. Thank you, Mr. Chairman.
Thank you, Mr. Scott. Today we welcome the testimony of Mr. Greg Baer, President of the Clearinghouse Association, Mr. Norbert Michel, Senior Research Fellow, Financial Regulations and Monetary Policy at the Heritage Foundation, Mr. Amias Moore Garrity, former Acting Assistant Secretary for Financial Institutions, U.S. Treasury. Mr. Bill Hempler, Executive Vice President of American Financial Services Association. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be part of the record. Just a quick tutorial on the lighting system. Green means go, yellow means 1 minute to continue to speak and wrap up, and red means it's time to pass on to the baton. So with that, Mr. Baer, you're recognized for 5 minutes.
Thank you, Chairman Luetkemeyer, Ranking Member Scott, members of the committee. I'm pleased to appear before the committee today to discuss regulatory process. Public input and a transparent process tend to produce better regulation, but the current trend is clearly away from both. My testimony will highlight areas where administrative process is broken down, harming the quality of regulation and the ability of banks to serve their customers. The first area is the Federal Reserve CCAR stress test. To be clear, the Clearinghouse believes that stress testing is the smartest way to evaluate the resiliency of a bank, but the CCAR process contains significant procedural and substantive deficiencies. Under CCAR, banks use models to forecast loan losses and revenues under a severely adverse stress. These models are reviewed and approved by the Federal Reserve and are regularly backtested to ensure accuracy. Nonetheless, in determining the bank's stress law and therefore its effective capital requirement, the Federal Reserve discards these results and instead runs a variety of its own models. Neither the formulas for those models nor their combined results have ever been subject to notice and public comment or any type of peer review. This matters because banks tend to shift lending away from sectors with higher implicit capital requirements under CCAR. For example, our research shows that the Federal Reserve's models impose dramatically higher capital requirements on small business loans and residential mortgages. Given the stakes involved, it is remarkable how little we know not only about the contents of these models, but also about their performance. This, too, is a black box. We urge that the Federal Reserve continue to engage in modeling as part of CCAR, but only as a check on the bank's own projections. If a given bank's models are deemed insufficient, the Federal Reserve's models can be offered as evidence in issuing a capital directive or in order to improve them. Although highly unlikely, if the Federal Reserve's models ever proved more accurate over time for a given bank, they could be adopted instead. Notably, this approach would alleviate any concern that making the Federal Reserve's models public would cause banks to cluster into assets that those models favor, causing an unhealthy concentration risk. Once generally non-binding, the Federal Reserve's models could benefit from peer review by the academic community in a way that bank models, which are necessarily proprietary, cannot. A second area is the CAMELS rating system, which was adopted in 1979, when there was no capital regulation, no liquidity regulation, and no stress testing. In other words, at a time when bank regulation was necessarily subjective. Remarkably, it has not been materially updated since. Over that time, CAMELS ratings have become progressively more arbitrary and compliance-focused, likely because capital and liquidity regulation have supplanted them as the best indicators of financial condition. All of this is significant because a low CAMELS rating, I believe as the chairman alluded to, is now generally treated by regulators as a bar on bank growth. A wholesale review of the CAMELS system is required. In the interim, its ratings should be made more objective and modernized. For example, the bank that is well capitalized under the 35+ capital standards currently applicable to large banks should be presumed to be rated a 1 for capital. Next, living wills. Title I of Dodd-Frank requires large banks to construct a prepackaged bankruptcy plan and requires regulators to review the credibility of that plan. This requirement is important and altogether appropriate. The required review, however, has been translated into a shadow regulatory regime with real economic consequences. For example, the most recent living will process has effectively ring-fenced some major bank holding company subsidiaries through capital and liquidity prepositioning. The costs of doing so are significant, but have never been debated. Another area where process appears to have broken down is supervision of bank corporate governance. Examiner oversight is increasingly subjective and arbitrary, more akin to conservatorship than traditional examination, and in almost all cases without basis in law or regulation. In some cases, examiners attend board of directors or board committee meetings, which both chills candid discussion and inevitably shifts the agenda away from corporate strategy and real economic risk and towards regulatory topics. Even when examiners do not attend meetings, they insist on detailed minutes so as to judge the participants' performance. Examiners are dictating reporting lines within management and to the boards of directors, as well as the proper jurisdiction of committees and their agendas. Consequently, we now frequently hear from bank management that more than half of board of directors' time is devoted to regulation and compliance, as opposed to innovation, strategy, risk, and other crucial topics. We actually did a catalog for our members of all the requirements by regulation or guidance that are imposed on bank boards of directors. It runs to 144 pages. In all these areas, more transparency and the ability of the public to evaluate the wisdom of these policies would, we believe, produce better outcomes. And I hope today's hearing marks the beginning of a change in that direction. Thank you again for this opportunity to testify.
We thank Mr. Baer for his testimony. Now, Mr. Michel, recognized for 5 minutes.
Chairman Lukemeyer, Congressman Scott, members of the committee, thank you for the opportunity to testify today. The views that I express in this testimony are my own, and they should not be construed as any official position of the Heritage Foundation. My testimony argues that there are countless opportunities to reform the federal financial regulatory system. It is full of counterproductive, overlapping authorities and duplicative efforts. There are three main issues that I'd like to address in my oral testimony. First, the U.S. has too many financial regulators. Banks, just for instance, could be forced to comply with regulations from any combination of the following: the FDIC, the OCC, the Federal Reserve, the CFPB, the SEC, the CFTC, the FHA, the FHFA, all on top of state regulators, just to name a few. While there is good reason to limit consolidation so that the U.S. does not have a single super financial regulator, the system is so cumbersome that some consolidation clearly makes sense. The trick would be to consolidate while guarding against efforts to apply bank-like regulation outside of the banking industry. A reasonable approach would be to reorganize so that the U.S. has only one banking regulator and one capital markets regulator. And the obvious place to start would be merging the CFTC and the SEC. These agencies regulate markets that have increasingly blurred into one another over the years and that are closely tied through common participants and common purposes. Indeed, the U.S. is unusual for having separate regulators for these markets. On the banking side, Congress could shift the Federal Reserve's regulatory and supervisory powers to either the OCC or the FDIC, and then merge those two agencies. The most important part of that type of reorganization, I think, is to get the Fed out of the regulation business. The Fed should be conducting monetary policy, nothing else. Regrettably, Dodd-Frank took us in the opposite direction and expanded the Fed's regulatory role, even though this move is counter to the trend found in most developed nations. More than a dozen developed countries, among them the UK and Sweden, have already removed regulatory functions from their own central banks. My second point would be that the U.S. did not need and does not need the Consumer Financial Protection Bureau. The CFPB is unaccountable to the public in any meaningful way and raises serious due process and separation of powers concerns. But most importantly, there was no shortage of consumer protection from fraudulent companies prior to the Dodd-Frank Act. Title 10 of Dodd-Frank created the CFPB, in part, by transferring enforcement authority for 22 specific consumer financial protection statutes to the new agency. These federal statutes were administered by 7 different federal agencies and layered on top of state laws and local ordinances. So it is reasonable to say that some consolidation may have been warranted. Regardless, for decades, this framework outlawed deceptive and unfair practices in financial products and services. And in fact, if Congress eliminated the CFPB right now, Americans would be just as protected against unfair and deceptive fraudulent practices as they are with the CFPB. Financial firms do not need another federal supervisor, and Americans do not need protection from themselves through the ill-defined protection regime against abusive practices. My final point is that given the political difficulty in making these types of changes, Congress should take a careful look at using the reorganization authority under 5 U.S. Code Section 901. Granting the president this authority, which has been used by presidents in the past of both parties, is a flexible way to enable the executive branch to propose viable government reorganization plans. These plans could be narrowly targeted to improve the efficiency and effectiveness of specific areas of financial market regulation, and they can be enacted by Congress more easily than if the legislative branch had to develop these plans from scratch. This route seems like a particularly good idea now because the Trump administration has started its formal review of financial regulation and specifically expressed a desire to improve its effectiveness and efficiency. Thank you for your consideration, and I'm happy to take any questions that you might have.
Thank you, Mr. Michel, for your testimony. Mr. Garrity, you're recognized for 5 minutes.
Thank you, Chairman Lukemeyer. Thank you, Chairman Lukemeyer, Ranking Member Scott, and members of the committee for the opportunity to be here today and to offer my perspective on the ongoing need for effective regulation and supervision of the financial system. It's important to start in the fall of 2008. A financial crisis of tremendous scale and severity left millions of Americans unemployed and resulted in trillions in lost wealth. Our financial system had evolved dramatically over decades, and the regulatory approach had moved in the wrong direction. For instance, derivatives were statutorily protected from oversight, and subprime lending and securitizations grew with little to no oversight. When the crisis exposed these massive inadequacies, we were faced with the unpalatable choice of either intervening to prevent certain institutions from failing or letting them fail at the risk of imperiling the entire financial system and plunging the country into a second Great Depression. Americans, nonetheless, paid a high price and lost wealth, jobs, homes, delayed retirements, and college educations. We all learned that in the end, our financial system only works, our market is only free, when there are clear rules and basic safeguards that prevent abuse, check excesses, and ensure that it is more profitable to play by the rules than to game the system. Dodd-Frank enacted a number of provisions that curb excessive risk-taking and hold financial firms accountable. However, the policymakers that drafted Dodd-Frank recognized that our financial system is dynamic and risks cannot be adequately addressed by a one-size-fits-all approach. Today, I would like to share with the committee 2 key points. First, the post-crisis Wall Street reforms have strengthened our financial system and supported our economic recovery. As financial reform was being implemented, the private sector added 15 million net new jobs, and household wealth grew by $30 trillion. At the same time, real GDP growth continued steadily since Dodd-Frank passed and remained positive, even as Europe weathered a sovereign debt crisis and the UK suffered a double-dip recession. Within the banking sector, recovery has been strong and widespread. The banking system is currently delivering on its promise to provide credit to the economy. In the past 2 years, community bank lending and earnings growth has outpaced the industry as a whole, with more than 10% income growth in 2016 and lending up nearly 9% year over year, both faster than the industry. Second, Dodd-Frank provides a clear and coherent framework to deliver regulation that is appropriate to the risk of individual institutions and the system as a whole. Dodd-Frank uses clear exemptions, statutory requirements for tailoring, and market-based rules to help assure that regulators are focused on a tiered and tailored approach. Regulators have responded to the statutory direction and used their discretion to consistently respond to legitimate concerns about regulatory burden and to create a tiered and tailored regime. Let us start with a simple but central point. A $200 billion bank is not the same as a $2 trillion bank, nor is it the same as a $20 billion bank, a $2 billion bank, or a $200 million bank. The U.S. banking system is far less concentrated than our peer-developed nations, and this diversity is a strength. In order to deliver a regulatory system that is appropriate to the risk, we must be clear-eyed about the risks we face. This means acknowledging that tough standards must apply to the largest, most complex institutions, and that we must have the tools to handle their failure. It is only by having a clear plan and clear legal authority that we can avoid the awful choices that we faced in the fall of 2008 between the panic-inducing failure of Lehman Brothers and the bailout of AIG. Removing the authority to liquidate large, complex financial institutions the way we have done for banks of all sizes would be a return to the policy of too big to fail. In closing, it is important to note that the goal of bank regulators must not be to satisfy the banking industry, but rather to satisfy the public interest. For that reason, the best test of how regulators are progressing through their work is whether financial markets are stable, loans are extended on clear and fair terms, and agencies demonstrate consistent openness to new approaches and an ability to flexibly apply their rules over time. Thank you, members of the committee, and I look forward to offering my perspective in today's hearing.
Thank you, Mr. Garrity, for your testimony. Mr. Hempler, you have a very high bar to every one of the previous folks who've testified have come under 5 minutes, so we'll test you here.
Mr. Chairman, I noted that as well, and I fully expect to use all 5 minutes.
You are recognized for your time plus theirs, I guess, huh?
I like the sound of that. Good morning, Mr. Chairman, Ranking Member Scott, and members of the subcommittee. I am the Executive Vice President of the American Financial Services Association. AFSA was founded in 1916 and is the only national trade association solely focused on consumer credit issues. As such, let me state at the outset that we stand shoulder to shoulder with members of this subcommittee on both sides of the aisle, as well as with the CFPB, in wanting to see bad actors eliminated from the marketplace. However, it is equally important to ensure access to affordable credit for all Americans. As the Federal Reserve notes, consumer credit balances, exclusive of mortgage, stand at roughly $2.5 trillion. Banks account for about 60% of this credit, but finance companies account for almost 1/3. Yet banks and finance companies represent very different business models. Federal regulators have a long history of effectively supervising banks. Finance companies, though, are creatures of state law and have been supervised and examined at the state level for close to 100 years. Trying to supervise banks and finance companies as if they're the same could be disastrous for consumers and the economy as a whole. To that point, then Representative Barney Franks, one of the authors of the Dodd-Frank Act, wrote the CFPB in 2011, stating that I urge staff to pay close attention to the differences of products offered by non-bank institutions and to be mindful of Congress's intent in financial reform that state consumer protection laws be preserved to the extent possible. He went on, for example, there are key differences in product characteristics between payday, car title, and other high-cost secured loans and more traditional closed-end unsecured lending and related products, and the products are often regulated differently in various states. He concluded, to the extent that state regulation has worked to protect consumers with regard to financial products offered by non-bank institutions, I encourage the Bureau to coordinate and work with states to preserve these protections. AFSA believes in CFPB's mission to help consumer finance markets work effectively by putting in place clear rules that are consistently enforced. But all too often, it feels as if the CFPB is following a gotcha mentality that is more interested in grabbing flashy headlines and punishing the industry. Furthermore, despite the CFPB's vast authority, it often manages to exceed the limits placed on it by Congress. Here are a few examples of what I mean. The CFPB issued a short bulletin that attempts to hold indirect lenders liable for discrimination resulting from dealer compensation policies. This is contrary to Dodd-Frank, which prohibits the CFPB from regulating dealers. It's also an example of guidance designed to function as rulemaking without due process of law. In this instance, the CFPB has pursued disparate impact cases against financial services companies without a valid legal basis, employing a proxy methodology it knows to be flawed, refused to consider non-discriminatory factors that could explain alleged pricing disparities, and employed a remuneration process that was designed to achieve a political end. As a solution, Congress should work quickly to preclude the CFPB explicitly from using disparate impact theory under ECOA. The second example of the CFPB's overreach can be found in its attempt to impose interest rate caps, which Dodd-Frank again prohibits the CFPB from doing. But that is exactly what the Bureau is attempting to do with its small dollar loan rule. The proposed small dollar rule imposes substantial and burdensome underwriting requirements on loans with a total cost of credit that exceeds 36%. Because these additional requirements are so costly, many lenders will choose not to make such loans to needy consumers. Keep in mind, these are institutions that had played no part in the financial crisis in 2008. This proposed rule imposes a de facto usury limit by making it uneconomical for many lenders to comply with these new requirements. In fact, in a hearing last year before this committee, the members of the committee pressed Acting Deputy Director David Silverman to specify what deficiencies in state law the CFPB was trying to address. And the Acting Deputy Director could not answer the members of this body. We asked Congress to encourage the CFPB to go back to the drawing board on this rule. My third example is the CFPB's use of regulation by enforcement. Despite the CFPB's authority to write rules, the CFPB chooses to govern industry by enforcement orders. But these orders are not consistent. For example, in the area of dealer compensation that I mentioned earlier, does the CFPB expect the vehicle finance companies to comply with the enforcement order against American Honda Finance Company or the enforcement order against Ally? These are two very different orders, and it's unclear. The CFPB also tries to utilize the unfair prong in UDAP regulation. For example, debt collection practices employed by Easy Corp were consistent with both federal and state law, and the CFPB did not like them, so they labeled them as unfair. The CFPB's UDAP authority should be removed and returned to the Federal Trade Commission. I see I've exceeded my time. I look forward to the questions of the members of this committee.
Thank you, Mr. Hempler, for your testimony. With that, the chair recognizes himself for 5 minutes. And Mr. Baer, I want to begin with you. We brought a visual this morning with regards to the CCAR process that represents 20 to 30,000 pages. That's the normal for mid-sized regional banks to comply with stress tests. I was discussing last night with one of the larger banks. It can go up to 100,000 pages for some of those folks, and they get back a 3 or 4 page letter saying that you don't comply and that you didn't hit the model that we had intended for you to do without any guidance as to how to hit a model. Would you like to elaborate a little bit on this? I know you talked a little bit about it in your testimony about how, and quite frankly, it would appear to me that from having an examiner background, that the examiners are in these banks on a full-time basis, the larger banks, and they see this information every day, and yet for the banks to have to compile this in these voluminous reports seems superfluous to me. Would you like to comment?
Sure. Yes, Mr. Chairman, yeah, if you think about CCAR, there are actually really two components. One is the quantitative assessment that I referenced in my oral remarks, and the other is the qualitative, which has uniquely, of all the types of regulations supervised by the regulators, become an annual binary public, life or death decision. You pass or you fail, and has not had a lot of standards around it such that banks can know whether they're going to pass or fail. To the Federal Reserve's credit, I think they've eliminated that or proposed to eliminate that for almost all banks. We obviously urge them to go ahead and do that for all of them. There's no reason that capital planning cannot be evaluated through the traditional examination process that you're aware of, just as any other credit underwriting or cybersecurity. So again, we think that should be subject to the same process. With respect to the quantitative test, yes, clearly there is an extraordinary amount of data that is submitted. The number of people at the banks working on this ranges from the dozens to the hundreds, full-time year-round. I think there are clearly ways that process could be streamlined and the burdens of that reduced. That said, I do think that one of the great frustrations of the banks is that they go to all this trouble, they do all this work, they produce projections of losses and revenue under the stress, but then those results are discarded. And the Federal Reserve runs its own models, which they do not see and actually, I think, don't have confidence are better than their own with respect to a particular bank. So I think that the burdens of this process would be more tolerable, I believe, and more sensible to the extent that the results actually mattered and weren't discarded.
Thank you. Thank you. In your testimony, you also made the comment that a lot of examiners attend regular meetings, and sitting there has a chilling effect, and I assume they don't participate in a meeting unless called upon, but it would seem to me that would be an example of them trying to micromanage the bank, which they're not supposed to be in the middle of this as a regulator. They're supposed to be on the outside trying to enforce the law. If the bank wants to make decisions based on a business model, they should be allowed to do that and not have examiners sitting there to try and have a chilling effect on their ability to actually perform what they need to do in order to be able to fulfill their mission. Mr. Hempler, you had a number of comments here with regards to CFPB, the rulemaking process, rulemaking, some of it to do without due process when they enforce things, and regulation by enforcement. Would you like to elaborate on the regulation by enforcement a little bit? I know to me, this is really problematic from the standpoint that this is an agency that promulgates a rule without Well, and then they go out and enforce the rule through fines and what have you, and basically, to me, that's a law. And there's only one group around here that can make a law, and that's us. And yet, that's what they're doing. Would you like to elaborate on that?
I would. First, I'd like to see things turn to regular order where Congress is the ones making law, as opposed to unelected folks in agencies such as the CFPB. I think it does go back to the founding author of the CFPB, Senator Warren, who expressed at the outset in creating this that rules are like fence posts on the prairie. They're useless. Lawyers try and get around them. So there's a new sheriff in town, and we've got to crack a few heads. That mentality has continued to reverberate through the Bureau. We've had CIDs, civil investigative demands, that have been hanging out over companies for years without any feedback from the Bureau as to whether or not somebody's been cleared or not. We've had different orders with respect to the vehicle finance industry in terms of which order a company should follow. And I guess most importantly, the Bureau put out a blog last year saying that they had backed off from pursuing this type of activity, but that activity still continues in examinations. Companies come forward with plans to actually try and work with the CFPB and get very little credit for it. Discover was one of the first enforcement actions that the CFPB took. They self-reported and got no credit for it. You would have thought the CFPB had identified that and rooted out a bad actor.
Thank you. My time has expired. With that, we recognize the ranking member, Mr. Scott, for 5 minutes.
Thank you, Mr. Chairman. Let me continue that line of question, if I may, with you, Mr. Hempler. And I listened very intently to your comments about the CFPB. But here's the rub. We need to protect our consumers from the bad actors out there. And I think that my situation is somewhat similar to yours, because as you recall, during the auto lending, indirect lending fight, I more or less tried to lead the way in examining, in my own estimation, there were errors made. But they were errors made basically in the methodology that was applied to determine who was being discriminated against. Not the function of the CFPB going after and trying to do its major function of protecting the consumer. And as I mentioned in my testimony yesterday, ours is a very complex, complicated financial system. Again, we have 70 million unbanked, underbanked citizens out there. The most vulnerable being many that are low income, African Americans, and others. So the question I want to ask you is, I'm not sure you agree, don't we need to make sure that all of our consumers, especially the most vulnerable, deserve financial protection?
Thank you, Mr. Scott. I couldn't agree with you more. Everyone needs to be protected, but in the area of vehicle finance in particular, it's a very fragmented market. You've got thousands of players that are competing for market share, but the lion's share of the folks that are being regulated are finance companies that are creatures of state law, that are putting their own capital at risk. It's a different business model than banks that are putting deposits on the line for lending activity. I think that what we're looking for, and Mr. Garrity got to it a little bit in terms of the bank sizes that he mentioned, where he stopped was a $200 million bank. What I'm talking about is institutions that are below $200 million in terms of activity. They're providing a meaningful service and just want clear rules for the road. It's kind of like a sheriff pulling over somebody where there's no speed limit posted.
All right, Ms. Hempler, thank you very much for that. I want to go to you, Mr. Michael, because you outlined somewhat thorough your recommendations, which were basically mergers, and you recommended merging like the CFTC and the SEC. Do you not feel that that kind of merger with two distinct entities would bring more confusion and less order to our financial system, given the fact of their jurisdictions? The CFTC strictly deals with this area of the commodities future trading and more or less handles this growing derivatives, markets, swaps, all of that business, cross-border, and dealing with a very growing and complex $800 trillion piece of the world's economy. So I don't see how that fits together.
I think so. I don't think there would be any more confusion than there is confusion between what is a swap and a securities-based swap. I think that's an artificial distinction was made in Dodd-Frank Title VII, and those markets are, although commodities are not the same as securities or derivatives necessarily, they are essentially all financial instruments that are, I would call, cousins. And the distinction that we've been making legally over time has grown to the point where it's almost pointless. Whether you're trading futures, whether you're trading derivatives, whether you're trading indexes, whether you're trading stocks, you're trading some sort of financial asset in the market, and these things are very similar.
The other point you mentioned, which I have some experience with, was the overlap and the confusion that takes place with our federal regulators and our state regulators. And I spent 28 years in the Georgia legislature, 14 now in Congress, and I could speak to that. One case in mind was we had to deal with fleet finance and their predatory lending. They were allowed to come into the state and use our usury laws for paying down second mortgages. But the point is that it was because we were able to get a better working relationship between what the feds were doing and what the state was doing. And this was a new frontier, and we had to create others. But I see my time is up. Thanks.
Gentleman's time has expired. With that, we go to the Vice Chairman of the committee, a gentleman from Pennsylvania. Mr. Rothfuss is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Baer, I'd like to ask you a couple questions. I have concerns about whether the current regulatory framework properly recognizes the various business models and risk profiles of banking organizations. Custody banks, for example, are very different from investment banks. The one-size-fits-all regulations are pushing banks to a one-size-fits-all business model and balance sheet. This homogeneity cannot be good for the financial system or financial stability. Do you have any opinion as to whether more tailoring is needed to preserve this diversity in business models?
Thank you, Congressman. I think custody banks are a terrific example of that in the sense that, I mean, clearly their primary purpose is to safekeep assets, but that also involves holding very large amounts of deposits. If you think about how the regulations affect a custody bank, the liquidity rules assume that those deposits, counterfactually, will all run in a crisis. Now, certainly deposits are at risk of a run in a crisis, but I think we saw in the last crisis that custody banks did not see large runs. But even if you assume that that's a fair assumption and that lots of those deposits will run, and therefore that you need to hold a treasury security against that deposit to be ready to fund that run, you then, for a custody bank, also have the leverage ratio, which requires you to hold the same amount of capital against that treasury security as you would against a junk bond or an illiquid loan. So they are put in a very difficult position, even though they're in an extremely low-risk business of having to hold very large amounts of liquidity and capital on the liquidity. The same liquidity that's being held for safety and soundness purpose, they're holding 6% capital against that, and that really doesn't make a lot of sense.
Yeah, I plan on introducing legislation shortly that would exclude custody bank funds held at a central bank from supplementary leverage ratio calculations. How would this measure impact the viability of custody banks?
Absolutely. I think it would assist not only custody banks, but potentially applying that to dealers. It would assist them in meeting liquidity requirements. It's interesting, actually, just back from Europe, the Bank of England recently took just that step and deducted deposits on reserve at the central bank from the leverage ratio in the United Kingdom. So clearly it's something they've thought about and makes a lot of sense. I mean, one of the ideas behind the leverage ratio is, in a crisis, you don't really know what any asset's going to be worth, and you go to that sort of ratio because you may have the risk weights wrong. But in no crisis has anybody ever gotten the value of cash wrong, or specifically cash on reserve at the Federal Reserve.
Dr. Michel, in your testimony you wrote, quote, leading up to 2008, financial firms funded too much unsustainable activity largely because of the rules and regulations they faced, including the widespread expectation that federal rules had guaranteed safety and soundness and that the federal government would provide assistance to mitigate losses. I find this interesting because one of the main narratives that we hear from the left is that the financial crisis was caused by banks that got out of control because of deregulation. Can you elaborate a bit more on which rules and regulations had the greatest impact in the lead up to the crisis?
Sure. And first of all, I'll reiterate, I think that's absolutely insane for people to say that there was deregulation and that there was no oversight of this activity. All of this activity took place under the direct supervision of the Federal Reserve, the FDIC, and the OCC, at the very least. I think if I were to sort of prioritize the rules that were screwed up and that contributed to this, I would start with capital requirements and then bankruptcy preferences. On the capital requirement side, you had a risk weight system that incentivized banks to load up on mortgage-backed securities, to not hold mortgages, and to lower their capital charge for just doing the mortgage-backed securities, which were guaranteed, everybody knew, by the federal government for the most part. On the other side of that, with the bankruptcy laws, a lot of the funding for these vehicles through swaps and repos were given exemptions from the bankruptcy safe harbors. So all the counterparties in those markets had very little reason to care how much of it they were writing and who they were writing it with, because they knew that they would be in the front of the line and be the first ones out the door with their money. Those would be my two main categories of those rules.
Are there similar rules, regulations, and practices today that are setting the stage for financial instability down the road?
Well, we've changed the risk weighting a little bit, but we haven't really fixed it in the sense that we're still depending on this crazy idea that the federal regulators or any group of any particular persons can get together and know exactly what those risks are going to be, what those financial assets are going to be worth going forward. And that's just not true. We've proven that already, and we have not fixed that part. And we're going through all the CCAR exercise as if we know exactly how a bank's going to operate in a crisis and exactly what's going to happen in a crisis and exactly how much money is going to be there to protect it. That's not history shows that that's not a good idea. That's what we've been doing, though.
Thank you. Yield back.
Gentleman's time has expired. With that, we recognize the ranking member of the committee, Mr. Clay from Missouri, for 5 minutes.
Thank you, Mr. Chairman, and I'd like to ask unanimous consent that a letter I have here from Public Citizen on the importance of Dodd-Frank and financial regulations be entered into the record, please.
Agreed.
Thank you.
Without objection.
Thank you, Mr. Chair. Earlier this year, the President issued an executive order directing the Treasury to consult with all members of the Financial Stability Oversight Council and produce a report on whether the current financial regulatory system meets several high-level, non-controversial principles. If the administration produces a report that resembles Chairman Hensarling's radical rollback of Dodd-Frank, known as the Wrong Choice Act, it would be very controversial and poorly received. Mr. Garrity, as a former Treasury official, what would your advice to the Treasury be as it conducts its review? Should they be focused on trying to dismantle the CFPB, repeal the Orderly Liquidation Authority, or other Dodd-Frank rollbacks?
Thank you, Ranking Member Clay. I'm glad to offer my perspective. I will note, just as a factual matter, the consistent review and regular engagement with the agencies on how rules are working is a standard practice of the Treasury Department. We conducted such an engagement in the spring of 2009, and we regularly engaged at the behest of the President and the Treasury Secretary over the years in lots of discussions. So I think that the fact of doing a review is, as the chair of this subcommittee said earlier, is a natural part of the responsibility of any federal regulator, policymaker in Congress or in the administrative branch. In terms of the recommendations, I think the central question is how we articulate the regulations, the statutes, and the guidance in ways that are appropriate to the risk. And how do we build on the progress we have made to make our financial system stronger, to make our financial system more fair, and also make it more effective. In particular, I would highlight areas like small business lending, where we've spent a lot of effort to try and promote small business lending among community banks. We did investments in community banks to help them support small business lending. And I think also along the theme of simplification, especially for the smallest banks in our system.
Thank you for that response. And Mr. Garrity, it seems that despite evidence to the contrary, Republicans and industry lobbyists think that the financial protection for consumers and community banks in Dodd-Frank are harming them and the broader economy. However, I know that Democrats work with representatives of trade associations, such as the independent community bankers, to craft wholesale exemptions for small financial institutions. For example, community banks and credit unions under $10 billion are not supervised nor subject to enforcement actions brought by the CFPB. And while they are subject to consumer protection rules, they were subject to these rules even before Dodd-Frank was passed. Indeed, all of CFPB's $12 billion worth of enforcement actions providing relief for 29 million consumers have been against large banks and non-banks, direct competition to the community banks and credit unions. Mr. Garrity, would you please comment on how the Dodd-Frank Act promoted community banking and shifted the regulatory focus to more risky large banks and non-banks that compete with small banks and credit unions?
Thank you. I think this is a really important point about the structure of Dodd-Frank. It's not just that there are affirmative exemptions, such as the one that you mentioned with the CFPB supervision, but also there's an affirmative targeting of making sure that the toughest rules apply to the largest and most complex institutions. This happens both in specific directions. For instance, under Title I of Dodd-Frank, there are specific enhanced prudential standards that only apply to the largest banks in the system, and those standards are further tailored by statutory mandate so that the so-called GSIBs, the globally systemic, the money center banks with trillions of dollars on their balance sheet, are subject to different rules. It's also true that with issues like derivatives or securitizations, which community banks and smaller regional banks simply do not participate in, the weight of those rules do not fall there. So in terms of both its affirmative exemptions and its direction in terms of creating tough standards, Dodd-Frank explicitly and implicitly carves out the community banks. I think there is still work to do to make sure that the rules already the banking agencies have talked about simplifying the Basel III rules, making sure that those issues are easier for community banks to comply with, and I think that's a very fruitful direction and should be taken further.
Thank you for your response. My time's up.
The gentleman's time has expired. With that, we go to the gentleman from Florida. Mr. Posey is recognized for 5 minutes. And by the way, just a minute, Mr. Posey, votes have been called. We're going to try and get in hopefully two more questioners here. So go ahead, Mr. Posey. Thank you.
Thank you, Mr. Chairman. Mr. Hempler, yesterday Director Caldroy appeared before the committee. And as you know, the Consumer Financial Protection Bureau has a mission, and let me just state it just precisely here, to make consumer financial markets work for consumers, arm people with information, steps, and tools they need to make smart financial decisions. I'm interested to hear your opinion about whether or not you believe the CFPB is in fact adhering to their mission.
Thank you, Mr. Posey. And I guess my first response would be to kind of follow on the discussion Mr. Garrity and Mr. Clay had just a second ago about independent community banks. That exemption is afforded to the community banks because of the high burden of having a federal regulator adding to the regulations that you're already facing at the state level. Representing finance companies that are providing both small dollar credit as well as vehicle finance, we would love to work with Mr. Clay and the members of this subcommittee and the full committee to get that exemption so that there's a level playing for all financial institutions. We're willing to play by the same rules as everybody else, but what we're talking about is the difference between profitability, sustainability, and the ability to provide affordable credit or being out of business and having to shutter your doors. One example of where I think the CFPB has missed its mission is in the area of its consumer complaint database. I don't think it really provides any information to consumers, information that is gathered in that database, namely through a narrative field that customers are able to utilize, is not verified. And most importantly, consumer information is not safeguarded. So from my perspective, that's something that really needs to be addressed in terms of meeting its mission, in terms of providing helpful information and protecting the consumer.
Again, offhand, can you think of any other steps you think should be taken to get back on course with the mission?
I would say also in the area of enforcement, our concern is that the Bureau is regulating by enforcement. It's not providing clear guidelines in the vehicle finance space in terms of utilizing not so much its abusive authority under unfair, deceptive, and abusive practices, but the unfair prong that has really never been used by regulators before. The reason it hasn't been used, it's very hard to create any sort of objective standard. Like I said at the outset in answering your question, our members are willing to play by the same rules as everybody else, and we do. What we don't think is in the best interest of the consumer is creating a gotcha environment where you don't know what the rules of the road are.
Yeah, I think the CFPB indicated at one time they might be required or requested to issue something like 50,000 opinions on interpretations of their rules. And they kind of committed to doing at least 1 to 3 a year, and to date they haven't done any. Do you see that as problematic?
Again, in the vehicle finance space, they issued a 4-page bulletin to provide guidance to lenders in the vehicle finance space. They have at least 3 public enforcements. They have other private enforcements. None of them look like each other, and the director has said it is regulatory malpractice for financial services players not to follow these orders. Which one do we follow?
Well, you know, we get statistics that we're now losing something like a community bank a day or something. I mean, it's unbelievable. Do you think this is a root cause of that?
I do think that is a root cause. We don't represent the community banks, but they're great players. Everybody has a part to play in this. But another proposed rule by the CFPB is its arbitration rule. The director's own economics team said that arbitration is better than litigation for the consumer in terms of time, convenience, and monetary awards. And yet his own statement when he rolled out this rule totally contradicted that. I will stand here and tell you today that a significant number of financial players that are that are small and community-based, if that rule goes into effect, those businesses will go out of business because they can't afford the risk associated with a class action lawsuit.
Thank you, sir.
Thank you.
Mr. Chairman.
Gentleman's time has expired. We're going to get one more question in here before recess. Gentleman from North Carolina, Mr. Pittenger, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Hempler, I'd like to ask you, do you think that there has been an uptick in the enforcement actions by the Bureau since the November elections? Is that your sense?
I do think that it's been sustained, but a lot of the enforcements are now through the supervisory process. And so what we have happening, as opposed to the more public orders that we've seen, is a lot of the enforcement orders are in the supervisory process, and they are not a matter of public disclosure. So it's very hard for our members to actually articulate what is happening to them. But I will tell you that, again, in the vehicle finance space, the CFPB said last December that they were moving on from this. I can tell you clearly they have not moved on from this, and they have, in fact, probably doubled down on this.
Do you feel like, in a sense, the CFPB has moved the goalpost?
I'm sorry, I missed
Do
you.
you feel like, in a sense, that the CFPB has moved the goalpost? Do you have any examples of that?
Well, I do think that it's interesting with respect to the bulletin that they put out. They put out a clear standard that was not achievable by industry. The vehicle finance industry is very fragmented, and nobody was willing to step forward. It said that all compensation to dealers had to be flat. Nobody was willing to go there. The first public settlement that they came out with dealt with monitoring. Two subsequent ones dealt with capping the compensation, and I can tell you another one actually came forward and offered to cap compensation, and we're still penalized for doing so.
Thank you. Mr. Michel, how was the consumer protection handled before the creation of the CFPB?
It was fragmented. It was spread around several different agencies. If you go through Title 10, I believe Subtitle H of Dodd-Frank, you can see part of what was done, which is it literally shifted enforcement authority for 22 federal statutes into the Bureau. So unfair and deceptive practices, primarily enforced by the FTC, Federal Trade Commission, are all under all of those authorities, and banking regulators also had the authority, although not the explicit statute requirement, the authority to enforce laws under those rules as well, on top of state regulatory agencies, all policing fraud. So the fact that there is deceptive and unfair practices, fraud, you cannot, as a business, lie about what you've sold me. You cannot mislead me. You cannot trick me. All of this was done, prior to Dodd-Frank, as Congressman Clay alluded to a moment ago himself. Smaller banks were subject to consumer protection laws prior to Dodd-Frank. And that's the body of that framework that you see there in Dodd-Frank.
Do you think that provided more protection to consumers, that process, or do you think the CFPB provides more protection?
The CFPB, the only argument you can possibly make is that we've consolidated that authority in one agency, and that's fine, but it didn't have to be the CFPB. It could have been the FTC. In fact, I think it made a lot more sense to be the FTC. They have a Bureau of Consumer Protection. That's their mission. So,
was there any benefit in consolidation?
I would say yes, there would be benefit in consolidating, and it was quite fragmented, so yes, but not with the CFPB, because the CFPB goes much further than that, and it is not really designed primarily to enforce those statutes. It's not an enforcement agency per se, like the FTC, and what you have is the agency is primarily designed to go much further than that. Particularly with abuse of authority, which is ill-defined and will not be defined under the Bureau and is not defined under the statutes. And it's really designed, if you look at the intellectual architects, Gill and Warren, the idea is that you have to protect consumers against themselves or from themselves. That's a very different concept than what was in consumer protection law prior to Dodd-Frank.
Thank you. Many members of the Financial Services Committee have spoken to Fed Chair Yellen about the need to tailor regulation to specific institutions. Do you think the prudential regulators do enough to tailor these regulations to an institution or to smaller groups of institutions? Mr. Baer?
Sure. I'd agree, Congressman. There can be more done. I think we already talked about a custody bank example. There are certainly other examples, for example, the living will process, which is a large resource drain on firms that are actually quite easy to resolve and don't need that level of planning. I'd also just say, and there's been a lot of talk about the CFPB, and in terms of tailoring, I mean, I think as Mr. Michel notes, at least in theory, the statute transferred Consumer Enforcement Authority away from the banking agencies and to the CFPB. I think what's happened, though, in reality is that the banking agencies have rechristened every consumer compliance violation as a safety and soundness issue, using this, say, amorphous concept of reputational risk, meaning if you do something I don't like, somebody else might not like it, that will hurt your reputation, therefore you have a safety and soundness problem. So that's another example. Maybe it's a different kind of tailoring, but that jurisdiction wasn't really transferred, it was more duplicated.
Thank you. My time's expired.
Gentleman's time has expired, and with that, we apologize to the witnesses. We do have to go vote. They've been called. We'll call a recess here, probably reconvene around 10:45 roughly. Mr. Williams is up next. Let's reconvene the hearing. Again, apologize for the interruption, but we do have to go do our job from time to time. So with that, we want to, again, thank the witnesses for their indulgence, and we will continue the questioning. Mr. Williams, the gentleman from Texas, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Mr. Hempler, as you know, yesterday our committee had the opportunity to hear testimony from CFPB Director Cordray. From his testimony, you would have thought that community financial institutions, which facilitate a significant amount of lending in my district in Texas, are doing great. But perhaps the director hasn't been to rural Texas, where many credit union and community banks have simply closed. So last year, 329 members of Congress and many of the members of this subcommittee sent a letter to Director Cordray calling on him to invoke his authority to exempt community financial institutions from CFPB regulations. Yet instead, he went ahead and released a 1,300-page rule on small dollar lending, which applies to community banks and credit unions. I'm not quite sure he got the message, but in your opinion, why does a small bank or a credit union need a 1,300-page rule to tell them how to make a $500 loan to their local customer or member?
Thank you, Mr. Williams. It's good to see you this morning. I don't know why any community financial institution needs a 1,300-page regulation. Most of the small dollar products are fairly clear on their face. We do not represent payday, but it is a very clear disclosure. Most small dollar extensions of credit are only a couple of pages in length, if that. There's clear disclosures of APRs. And the rule that the Bureau has come forward with will cripple access to credit, particularly in communities that you're talking about. The whole rule, I must admit, I find personally offensive. No one would dare ask members that have premium or gold credit cards to have a cooling off period after they paid off their monthly statement for March or April. But that's exactly what we're doing to working class and lower income folks. And to me, that is unfair.
Well, and staying with that line of question, Mr. Hempler, I want to talk about an issue that unfortunately I did not have time to discuss at yesterday's hearing. In March 2013, the CFPB issued a bulletin that allegedly provided guidance for indirect auto finance companies. We now know this was the Bureau's way to get around Section 1029 of the Dodd-Frank Act, which explicitly excluded them from the CFPB oversight and rightfully left the duty to the FTC. As the story goes, the CFPB used a now debunked study citing desperate impact to hold the indirect auto finance companies liable for discrimination resulting from dealer compensation or markup. So why is the Bureau continuing to utilize this methodology in enforcement actions against banks and indirect auto finance companies?
That's probably a question best suited to the Bureau. I can tell you that having worked with the CFPB and represented indirect auto for 13 years now, the staff has this kind of stuck in their craw, that dealers are exempt under Dodd-Frank, and the only way to address that shortcoming that they see is to do it through vehicle finance companies, like the ones that I represent. And despite the fact that they have issued a bulletin, or actually a blog, last December calling a truce, that may be the case for public enforcement orders, but it is not the case in supervision and enforcement that stems from that. That continues to go forward. And even in instances where finance companies are trying to do the right thing and meet the Bureau halfway, I'm afraid that all too often the Bureau is still looking for the flashy headline.
I agree with you. In their semi-annual report, the Bureau has dropped ECOA auto lending enforcement from its fair lending priorities just this past year. The director himself has said that CFPB has abandoned work in this space. You've touched on that. Yet, in my opinion, the damage has been already done. So by my count, the CFPB has already extorted hundreds of millions of dollars from these auto lending companies. In your opinion, why do you think the Bureau has abandoned its work in this space?
I think the curtain has been pulled back on their flawed methodology, the fact that they were unwilling to account for non-discriminatory factors that we presented to them to explain any disparities that they found, and the fact that you had bipartisan pressure trying to get the Bureau to come forward with some sort of regular order, even in just trying to figure out how they did the methodology in terms of trying to duplicate their efforts. It took industry a year and a half for them to even turn over the computer code. I mean, that's just silly, Congressman. Uncalled for.
Thank you for your testimony. I yield back.
Gentleman yields back his time. With that, we go to the gentleman from Georgia. Mr. Loudermilk is recognized for 5 minutes.
Well, thank you, Mr. Chairman, and Mr. Hempler, welcome, and thank you for being here today.
Thank you for having me.
Yeah, well, maybe we'll have a little more productive meeting today than what may have happened yesterday when it comes to actually getting some questions answered. I'm going to follow on kind of the direction that Mr. Williams was heading in, that some questions I asked yesterday that was not adequately answered. There were a lot of things said, but I don't think actually addressed the question at hand. And a lot of it has to deal with the CFPB and their database. And let me kind of just pose a question I did to Mr. Cordray yesterday and see if you can help me get to some of the answers, at least what you believe that the truth would be there. In their annual report, which came out Monday, their numbers showed that in 2016, CFPB handled 291,000 consumer complaints, and about 17,000 of them were resolved with monetary relief for the customer. Now, that equates to only 6% of the complaints being resolved with monetary relief, and 94% had no monetary relief. So my question was, is this low number show that the vast majority of their claims really have no merit, or is it just incompetence in the agency, or is it a priority issue, in your opinion, or from your knowledge? Could you help me in that?
I'd actually like to give the Bureau a little bit of credit here. I think the fact that you have such a low numerical value associated with monetary rewards means that you've got the lion's share of complaints that come into the Bureau that may not warrant a monetary reward. We've had complaints come in regarding one of the captive auto finance companies under a particular brand, and they didn't actually finance the car. It was financed by one of their competitors, and it took them a while to sort it out and make sure the complaint got to the right consumer, and it was resolved. That's just one instance. But I do have other problems with the database. This is reputational risk at its finest. No one in our industry can afford to take on their federal regulators, let alone a federal regulator that has consumer protection in the title. What's the upside to that? Okay? Then you have numerous mistakes. They've now put in place a narrative field that allows consumers to put something online that's totally unverified. Well, how do you correct that? Once the damage is done to a company, it's hard to get your reputation back.
And I agree.
And probably most importantly is the fact that they don't protect the consumer's private information on this database. If the whole goal of the CFPB is to protect consumer, protecting their private information should be forefront.
Why would and I appreciate you going that direction, because that's really where I was going with. Out of the 96%, there has to be a large number of that, let me use the term frivolous. And in his testimony yesterday, Director Cordray said that once the company has an opportunity to respond, this is when a customer posts something on their website, a complaint, that they confirm that there was a commercial relationship with the customer. That's the extent of any confirmation. Why will they not go and at least try to validate the complaint? Because, as you say, once that reputation has been damaged by a consumer protection agency, it's irreparable. It is very difficult.
That is correct. I think at the end of the day, although it's listed as a consumer complaint database, there's no real interest in terms of, looking at both sides of the equation. As I said at the outset of my statement, we share the CFPB's mission to protect consumers, but that has to be balanced with ensuring the availability of credit. And all too often, I'm concerned that the Bureau does not have that balance in mind.
So is the purpose of the database just to name and shame companies, or should they have a disclaimer on there that says it's a fact-free zone or this is fake news? I mean, it's really what I see is happening here.
As entertaining as that is, yes, something needs to be done, particularly in this space, in terms of protecting reputational risk, because that comes at a cost. It will drive companies out of business.
Thank you. I yield back.
Gentleman's time has expired, and with that, we go to the gentleman from Tennessee. Mr. Kustoff is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Baer, good morning to you. I recently had the privilege of talking with a good community banker in my district in Fayette County in West Tennessee who talked about the Community Reinvestment Act. He said that while the intent of the CRA was to create fair lending practices, the current test criteria are often so stringent, so tough, that it makes it impossible for smaller institutions to provide credit to those who want to reinvest in the communities that they live in. We know that the CRA was designed to ensure that financial institutions were providing capital and meeting the financial needs of the communities in which they operated. Regulators have ensured that these institutions meet the requirements of the Act through tests that look at the bank's lending, investment, and services. Until recently, these tests provided a clear benchmark for a bank to meet its CRA responsibilities. However, lately, regulators have been increasingly included in their CRA examination criteria unrelated to the CRA, including compliance with other financial laws or consumer regulations that have their own standards and penalties for violations. I bring all this up because in your testimony, of course, you mentioned that one institution was graded by the OCC as outstanding, but yet then was later downgraded to, I think you said, needs to improve because of issues related to the bank's account management. Does that seem like a reasonable process to you?
No, Congressman. And I think the important point is that process or that kind of behavior actually undercuts the value of the Community Reinvestment Act. I mean, as you note, the legislative history and clear statutory purpose of the Community Reinvestment Act was to ensure that banks are meeting the credit needs of all the people in the communities they operate in. And the grades, it's outstanding. It's outstanding for meeting credit needs. That's the focus of the statute. And it is a good example of how the examination regime around this has actually worked pretty well in the sense that the standards, the three tests you mentioned, are applied rather objectively. Banks know what they need to do to get a satisfactory rating, what they need to do to get an outstanding rating, and they can benchmark that and know where they are. That's all somewhat ancient history now, but certainly not true now. What's happened is that any consumer compliance violation now can result and likely does result in a downgrade of the CRA rating. There are plenty of other consumer laws to punish that kind of behavior, whether it's informal supervisory or formal enforcement action or state action or Justice Department action. So it's not like this sort of behavior would go unpunished but for the CRA. But the unfortunate consequence of adding the CRA to the list of punishments for that kind of behavior is it diminishes the transparency of how it's applied to banks, and it really gives them less of an incentive to stretch, to make the extra loans, to become either satisfactory or outstanding. I mean, firms used to actually like, even aside from the compliance aspect, sort of the marketing of being an outstanding CRA institution. But if you tell them going into the exam, well, you have an unrelated consumer compliance violation, you're going to have a needs to improve no matter what you do, that really undercuts for everybody, the banks and then also the communities who want the lending, the value of the CRA.
Thank you very much, Mr. Baer. Mr. Michel, if I could, your testimony about the CFPB, I heard that. I think we all have heard that, your testimony and your opening statements. Yesterday, when Director Cordray appeared, I had a line of questioning involving the unfair, deceptive, or abusive acts or practices, the UDAP authority that was granted to the CFPB. As we look at the statute as written, it appears that there's little guidance as to what actually constitutes an abusive act or practice. Without clear and consistent guidance to make sure what that determination is, the Bureau now apparently has the discretion to make unilateral decisions that ultimately result in the elimination of a useful practice and service for the consumer. If I could ask you, in your opinion, has the CFPB adequately defined what constitutes, quote, an abusive practice, close quote, and is more clear and concise guidance needed for the CFPB to demonstrate further transparency in the process?
They haven't clearly defined it, and Cordray has said that they don't want to define it and shouldn't define it. And I mean, that's not the rule of law. We're going to figure out what you did wrong after you did it, and we'll tell you. I mean, that's absolutely 100% counter to the rule of law and the type of governmental system that we have in the United States. So, and then the next part of your question, as to whether they should clarify that, the only thing that we know is that it's not unfair or deceptive, so it has to be something else. Well, the question should be, what's wrong with unfair and deceptive? In other words, if unfair and deceptive is not okay, if it's not enough protection, then let's talk about something else. But that debate was never really had. So I don't think that I don't think that we should waste any time trying to force them to come up with a better guidance for abusive. I think that should be thrown out. It's in my opinion, superfluous.
Thank you. My time's expired. I yield back.
Gentleman's time has expired. With that, we go to the gentlelady from New York. Ms. Maloney is recognized for 5 minutes.
Thank you so much, Mr. Chairman, for calling this hearing, and very good to see Mr. Baer and some other constituents here, and all the panelists for being here today. We've got a busy day on the floor. We had one important financial services bill that came out of this committee that we were debating and just passed unanimously. That doesn't happen often in this Congress, unanimous support. So, Mr. Garrity, I'd like to ask you a question about the Orderly Liquidation Authority. One of the main changes, as you know, that we made in Dodd-Frank was to give the regulators to wind down large non-bank financial institutions when they fail. The FDIC has long had the authority to wind down commercial banks, but they did not have the authority to wind down large non-commercial banks like Lehman Brothers and AIG. And I distinctly remember one weekend, beginning the weekend with 11 investment banks in my district. At the end of it, every single one of them had failed. Yet I give strong support to the FDIC. They very, very expertly worked with the private sector to save the commercial banks, to wind them down, to merge them, to keep them moving. So we were really forced with two decisions. We could either bail it out like we did, or with AIG, or we could let it fail, which we did with Lehman. Neither was a good option, as we all know, and if anything, contributed to more confusion and pain in the financial crisis. Dodd-Frank gave the regulators a third option, an orderly wind down that prevents a government bailout, but does not harm the broader markets, so that they would have another tool, God forbid that we have another financial crisis, but that we could better manage it. So Mr. Garrity, I'd like to ask you to talk about this structural change and why it's important, and what would happen if some of my Republican colleagues are very intent on repealing the Orderly Liquidation Authority, although it says expressly in the statute that no taxpayer money should ever be used or can be used. So it's really a prevention of using taxpayer money and gives them another tool to really react to the crisis, as the FDIC was able to do with the powers that were given to them. So your thoughts on that, and any other panelists who'd like to add comment on it, we'd like to hear what you have to say. So, Mr. Garrity?
Thank you, Congresswoman Maloney. I think this is such an important issue, and you've laid out the facts as we saw them in 2008 so eloquently. I think there are a couple of principles at stake that are really important to highlight in any debate about how we handle the failure of a large, complex financial institution. The first principle, which you've outlined, is the fact that this authority did not exist in 2008. The choices were limited, and the fact that those choices were limited was a massive problem for the American people. The second is that market discipline works when firms have the ability to fail. Market discipline does not work if the market does not believe that firms have the ability to suffer from their own mistakes. And so I think we've seen already in the implementation, the development of the capital rules to go along with orderly liquidation, the strategies of the single point of entry that give that credibility, we've seen the markets react positively. And when I say positively, what that means is they've taken away the assumption that the government will step in. The rating agencies have noticed this as well. So I think moving in the opposite direction would be a move away from market discipline and a move towards too big to fail. I think the second thing is that there's often a discussion about bankruptcy versus orderly liquidation, and I think it's important to not see those as substitutes. Certainly, this House has worked on a bankruptcy bill focused on financial services. That should be seen as a complement. It cannot be a substitute for the approaches that we know have worked and the approaches that we know need to be differentiated for financial services companies because of their extreme size and their different structure than regular corporations in America.
Okay, I'd like Mr. Greg Baer, if he would like to comment.
Sure, thank you, Congressman. I think it's important to note, and as I think Amias did, that under the statute and quite sensibly, the first option is bankruptcy. That's why banks are submitting living wills, and either all now have or probably soon will have credible living wills under the bankruptcy code. So at that point, it's really a cost-benefit analysis. What's the cost of retaining Title II? What's the benefit? Given, you can argue the benefit is low in the sense that banks are now extremely resilient at extremely high capital liquidity levels. There's a credible bankruptcy process using the single point of entry strategy that Amias mentioned, and there's even liquidity available because they're prepositioning liquidity, or the trigger for bankruptcy is now sufficiently high that there will be liquidity available through the living wills. On the other hand, there doesn't really seem to be much of a cost at this point of retaining Title II as a backup plan, in the sense that, as noted, markets are pricing the debt as if there will be no government support, so there's not a moral hazard being created or an unfair subsidy. That's been validated by the GAO, by 2 other recent studies, and by the rating agencies now as well. So, it's a backup plan. I think it's an unlikely to be used backup plan, but it appears to be a backup plan for which there aren't a lot of costs to retaining.
And it would have been a backup plan that would have been helpful in the 2008 crisis. And we don't know what the next financial crisis is going to be. As you said, banks are very well capitalized now, so it won't be like the last one. It'll be something different. So having tools to respond might be helpful. Thank you all for your testimony. Thank you, Mr. Chairman.
Gentlelady's time has expired. With that, we go to the gentleman from Michigan. Mr. Trott is recognized for 5 minutes.
Thank you, Mr. Chairman, for calling this hearing, and I want to thank the panel for spending time with us this morning. And as has been mentioned, we spent about 5 hours yesterday with Mr. Cordray, and not sure how productive of a discussion it was, but I want to share with you a couple of the statements he made and get your thoughts. Mr. Michel, at one point, Mr. Cordray said, certainly no one can claim that their voices are not heard at the CFPB. And when I had occasion to ask him a few questions, I told him I was astonished at that statement, because I go home every weekend and I talk to realtors and title agencies and mortgage brokers and debt collectors and attorneys and small business owners, and they're all terrified of the CFPB. In fact, one constituent recently said they're like the mafia. They show up and they say, "This is a nice business you have here. I hope nothing happens to it." So I want to get your thoughts on whether you feel there's an adequate framework for people to bring questions, honest business people, to bring questions to the CFPB. If not, maybe give me a few examples of their failure in that regard. And then finally, what the consequences for our economy are of an operation that runs itself providing guidance through enforcement.
Sure. It's all right. I've heard and firsthand, and Bill probably has 1,000 times more firsthand accounts than I do, of people who say that this is not true, that the CFPB does not listen to them in the mortgage industry and outside of the mortgage industry. So I don't think, no, I don't believe that that is accurate. I don't believe they do listen. That's not why they're there. We had Dennis Shaw, who is an ex-Barney Frank staffer, talk to us about how different the Bureau became versus what it was pitched as it was going to be. And I mean, yeah, no, I don't agree with him at all.
Great. So, Mr. Hempler, let's go to another statement he made, and I questioned him on his press releases, particularly a press release that was issued August 26, 16, regarding First National Bank of Omaha. And the press release made it sound like the First National Bank of Omaha had basically admitted guilty to egregious transgressions and where they were just a terrible organization. But then when you look at the settlement agreement, Section 2, there was no admission of guilt of any kind. So you mentioned a few minutes ago they're prone to flashy headlines. And I'm just wondering if you think some of the press releases issued by the CFPB in connection with their settlements of enforcement actions are accurate, and largely whether you believe there's really a due process issue when you consider the fact that fighting the government really is a tough road to hoe for many companies given the reputational risk, and again, what the consequences of that method of operation is.
Thank you, Mr. Trott, and if you'll indulge me, I would like to comment on
Please.
Your question that you asked Mr. Norbert just to start off. I do think that, I'm sorry, Michel, sorry, Norbert, that don't take our word for it. The Small Business Administration, under the previous administration, actually opined on this, because a lot of the rules that the CFPB has to put forward have to go through a small business review panel to anticipate the impact on small businesses if they were to go forward. The SBA said that the CFPB was not listening to folks. That's, and Norbert's correct. I do have plenty of other examples. I would love to talk to you about them offline. A lot of the discussion, even Mrs. Maloney's previously, was about big institutions, too big to fail. We're talking about institutions that are too small to succeed. And if you guys don't get it right, with all due respect, you can have serious consequences and take a lot of folks that have institutions and access to credit in rural areas right out of the equation. With respect to the press releases, more often than not, we see press releases that don't reflect the orders that the Bureau puts forward. More importantly, sometimes the parties that are subject to those orders don't even see the order until it's actually been issued by the Bureau. That's being convicted before you even see the indictment, sir, and there's nothing more unfair than that.
Yeah, when I asked the director about his press releases, his response was, I know the facts. And it sounded, and I don't know that he particularly appreciated this analogy, but it reminded me of the line from A Few Good Men when Jack Nicholson was on the stand. He said, you can't handle the truth. And, you know, he's acting as judge and jury. And so how would he feel if I drafted a press release saying, Director Cordray admitted responsibility for sex and racial discrimination at the CFPB and retaliatory actions against his employees, apologized, said it would never happen again, but no one there is going to be fired as a result of their bad behavior. You know, I know the facts. I read the National Review article, so how can you dispute that?
Sir, as far as I know, all of the public orders in the vehicle finance space, none of the companies admitted to guilt. That was part of an agreed-to consent order, and the press releases all, from top to bottom, say that they're guilty, and then in the fine print say, but nothing in here actually reflects the order.
Thank you for your time. I yield back.
Gentleman's time has expired. With that, we go to the gentleman from Kentucky, Mr. Baer, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I appreciate the testimony of our witnesses. Dr. Michel, I was particularly interested in your proposal to remove the supervisory responsibilities away from the Fed and transfer them to other regulators, and proposals to consolidate regulatory activities. As chairman of the Monetary Policy Subcommittee, I've raised that proposal with Fed governors and regional bank presidents. And as you might imagine, I got a little pushback on that idea. And what they've said to me is that their supervision informs their monetary policy. Can you speak to that argument?
I'm not surprised, and I think that's scary. That's not the way this is supposed to work. Monetary policy in a fiat money system is supposed to be, the central bank is supposed to provide liquidity to the system. It's not supposed to be making bank determinations or bank safety and soundness determinations and picking and choosing who to lend to. That's the problem, literally. So the way to stop that is to let the federal regulators do the regulating on the safety and soundness and let the central bank provide liquidity to the system. It can do that in a very open and transparent process without emergency lending authority, without regulatory authority. That's all it has to do.
To the extent that the Choice Act or other reform efforts here in Congress maintains this concept of a stability oversight council, even if Congress were to remove its designation authorities, should the Fed participate in an FSOC?
In the unfortunate event that you retain the FSOC, no.
Okay. To your point about overlap, duplication, and inconsistency in the excessive number of these regulators, could you address the argument that multiple regulators can, in fact, lead to greater accountability, and talk about that in the context of this argument of race to the bottom?
So the research on this is pretty muddled. There are arguments for regulatory competition and that you get better outcomes that way. There's very little support for the race to the bottom hypothesis, and there's also some support for the idea that regulatory competition turns out to largely end up being a myth. If you look at bank failure rates, and this is just one example, it's admittedly muddled research, but one example is that bank failure rates across the different federal regulators were pretty much the same. So it's pretty hard to say that there was sort of like a charter shopping thing going on and that some regulators were being tougher or easier on others. That's it.
One final quick question, if I could, and then I want to move on to Mr. Baer, but talk about your proposal of regulatory consolidation in the context of the dual banking system, and specifically, what do you propose with respect to state-chartered Fed members, and who would be regulating them besides the state financial institutions regulator?
I think you just have to go to the FDIC.
FDIC,
I think
okay.
that would be my preference.
Mr. Baer, I was interested in your testimony, particularly about the CCAR qualitative assessment over bank capital planning processes. Talk about the arbitrariness of that and why you think we should get rid of that qualitative assessment.
Sure. I mean, I think the place to start is the regulators and the examiners, including the Federal Reserve, routinely assess the quality of banks' processes and their compliance with law across a whole wide range of activities, whether it's credit underwriting, cybersecurity, trading, anything. In none of those cases do they feel the need to announce publicly at the end of the year, pass or fail. They work diligently with the institution throughout the course of the year. Their findings are reflected in an examination rating, and that system works. Especially in an area where, like capital planning, you already have the quantitative assessment, which is, and I think will continue to be public. But the real question is, what's the value added by having that final assessment be public and binary? And there's also been, I think, a real sense, and I think some public reports around, that this function has been transferred largely from the exam teams to Washington. I think the standards are not particularly clear. There isn't a lot of very good feedback, such that we routinely hear that firms simply do not know going into that week whether they're going to pass or fail, which is not the way the exam system is.
And sorry to cut you off, but with my remaining time, Mr. Hempler, can you address the unique challenges associated with regulation of finance companies as opposed to banks, credit unions, and other lenders?
Sure. This isn't a problem with the CFPB. It's a problem in D.C. D.C. is a bank-regulated town. Finance companies and a lot of community banks are creatures of state law. They've been effectively regulated at the state level for close to 100 years. And trying to put community institutions through the same pace as some of the bigger institutions in the tens to hundreds of billions just doesn't work.
Back. Thank you. Yield back.
Gentleman's time has expired. With that, we recognize the gentlelady from New York, Ms. Tinney.
Thank you, Mr. Chairman. Thank you to the panel for being here. I like what I'm hearing from Mr. Hempler down there. As a member from rural, suburban, central New York, where we have a number of small businesses and some of the largest outmigration of people, businesses in the nation, and I've just found out today that in my district, some of the highest property tax rates based on per thousand. I just wanted to focus a little bit on Operation Choke Point and just the nature of Occupation Choke Point and how it focuses on small dollar lenders, payment processors, and companies that are believed to be reputational or moral risks. And what I'm concerned about what could happen in my district, particularly because we do have a number of small businesses that would probably fit that definition. One being Remington Arms, the oldest continuously running manufacturing firm, which happens to be large, but there are other smaller offshoots, such as in Oriskany Arms, that could be targeted by an Operation Choke Point, a small startup that's making firearms for right now for the hunting and personal protection. But Remington also, provides for our military. But other smaller businesses, whether it's payday lenders, check cashers, coin dealers, some people who provide some kind of services for people who are largely unbanked because of the massive regulation of so many of the big banks. As we regulate the big banks, we end up hurting the small banks even larger. And as a small business owner, it's sort of a parallel. We know we have a hard time complying with New York's regulatory burden as a small business. We can't afford to hire compliance agents, just like in a smaller bank. And I was just struck by your comment about, too small to succeed. And I'd like to say they're too small to be cared about by a lot of politicians and bureaucrats. Small businesses, small lenders, and people who are in these, persona non grata categories. I'm just concerned that some of these tactics by DOJ, FDIC are using are, they're almost like threats to increase the scrutiny on these types of lenders. I know we've written a number of letters, and I know I'm getting, we've written a number of letters to FDIC and OCC about Operation Choke Point and how it's affecting our industry. I just want to know, and I guess I'd single out Mr. Hempler since you have the great quote of the day with too small to succeed. Can you wager a guess, and I think you could probably give me a more educated answer as to why the government agencies believe that these licensed legal businesses that I've described should not have access to the banking system, and why we put them into the underground, and maybe you could answer why they're so targeted, it appears, from the regulators.
Well, thank you, Ms. Tenney. And in full disclosure, I wish I had come up with that quote, but I heard it from someone else.
Yeah.
I think your point is dead on. And whether we're talking about choke point or whether we're talking about using the unfair prong of UDAP, you have folks in the regulatory community, be it at the CFPB, FDIC, and others, that feel a need to stand in place of the judgment of hardworking Americans and how they utilize the credit system. And whether we like it or not, the FDIC can say that they're no longer deploying choke point. That message has not gotten down to the rank and file. Our members are still being subjected to the questions that call into question whether or not they're a moral provider of credit. Our association is 100 years old. We were formed with consumer groups in order to provide access to credit for hardworking Americans at the turn of the last century, folks in steel mills, folks in factories and the likes that banks couldn't provide credit to. And we take great pride in the fact that we're able to work directly with the consumers that we serve. But the CFPB and the FDIC and others have made it increasingly difficult by not following a rule of law, not providing clear guidelines, and coming up with squishy standards such as unfair because somebody doesn't think it's appropriate. All we're looking for is to be treated fairly.
Do you think that some of these are targeted or calculated attempts to eliminate an industry that might not be, or someone that's involved in a banking institution or a financial institution of this nature that's just not desirable in their world?
I do think that's the case, and I don't want to cast aspersions, but I think what we're dealing with, especially at the Bureau, is a lot of very young examiners right out of college, very idealistic. and think that they know better than the folks that they serve.
Thank you very much. I think my time's out.
Ladies' time
Thank
has
you, Mr.
expired.
Chairman.
With that, we go to the gentleman from California, Chairman of the Foreign Affairs Committee, Mr. Royce.
Thank you, Mr.
Recognized for
Chairman.
5 minutes.
Appreciate it. Mr. Baer, I appreciate your expertise on the issue of combating money laundering and the financing of terrorism. We had a hearing last week, and I shared my concern at that time that we're misaligning our resources and hindering legitimate consumers and businesses from accessing capital. And I specifically referenced the clearinghouse's research on the subject, which concluded that the billions in bank resources spent on AML-CFT compliance have limited law enforcement or national security benefit. Now, that was the conclusion. Now, to be clear on this, I know you agree that banks should be spending ample resources on AML-CFT compliance, as do I. But we've missed the mark on creating a framework that emphasizes identifying and catching the bad actors. So examiners seem at this point to be more concerned with quantitative metrics. So the metrics are, how many compliance officers have been hired or suspicious activity reports have been filed. But I'm looking here for your direction in terms of what legislative steps would you have this committee take to better align our regulations with the goal of protecting the financial system from illicit financing, which was the original intent.
Thank you, Congressman, and thank you very much for your leadership on this issue, which has been continuing and important. I think what we see, and it wasn't just the clearinghouse, we worked on this report, which I will waive, with experts in law enforcement, national security, global development, diplomacy, and everyone really came to pretty much the same conclusions, both about the problems with the system and the ways to fix them. And the fundamental problem is not a resource problem, it's a management and leadership problem. And it comes down to the analogy I use is that you have one person teaching the course and another person drafting the exam and grading the test. And law enforcement and national security and development folks and others are not engaged in the enterprise of telling banks how to spend that money. They don't give them direction, goals, priorities. Instead, as you note, they are graded by bank examiners who do what bank examiners naturally do, which is look for policies and procedures and rigid adherence to those policies and procedures. So what law enforcement and national security want are financial intelligence units that think very cleverly about how to find a human trafficker or a terrorist financer. And what the examiners have to, in practice, do, because they're actually excluded from that process. They really don't know what happens after these SARs are filed. Law enforcement doesn't talk to them, national security doesn't talk to them. They check boxes. And that's not a really very smart system. A lot of this could actually be reformed by Treasury, TFI, and FinCEN, working with the regulators. Congress can certainly help in certain areas, I think expanding information sharing under 314B of the Patriot Act. And then really importantly, and I know this committee has in front of it, legislation from Representative King and Representative Maloney on so-called beneficial ownership, or eliminating the use of anonymous companies to cloak who owns these companies.
And that probably would be a huge step if we could do that. I've got to turn to Mr. Michel. We've already seen the failure of a model that separates consumer protection regulation from safety and soundness regulation with respect to the GSEs. As the former Fed Chair Alan Greenspan noted after the financial crisis, he says, Fannie and Freddie paid whatever price was necessary to reach the affordable housing goals put in place by Congress in '92. Now, the result of that was the GSEs purchased more than $1 trillion in junk loans. When we rang the alarm bell, when we tried to pass legislation, I had a measure on the House floor, to rein in the GSEs, our efforts were blocked as a tax on affordable housing. We had two agencies tasked with entirely different, often conflicting objectives at the time, okay? So my question is, are you concerned that we've gone down this road with the CFPB? For example, I look at the planned overhaul of overdraft rules. If the CFPB gives borrowers 21 days to repay an overdraft rather than requiring it to come out of the next deposit, does it not morph into a line of credit that the bank will need to hold capital against? In other words, where do safety and soundness concerns here come into play? where does the prudential regulator have that responsibility to take a look at that issue, if you could respond? Do you have that same concern?
I'm sorry, I didn't hear the last
You
part.
have that same concern?
Oh, well, yes, and I don't think adding another federal regulator on top of the process does anything to fix this. And I think the whole premise is wrong in that the idea is the idea that finance companies, community banks, or big banks don't want to succeed and want to lend to people that cannot pay them back. You've got the whole thing is twisted. So I mean, you have to start by uprooting that. That's my.
Thank you very much, Mr. Chairman. Thanks.
Gentleman's time has expired. I'd like to go with a second round. I've got a couple follow-up questions myself. I know Mr. Baer's got a couple, and so with that, we want to recognize the gentleman from Kentucky, Mr. Baer, for 5 minutes.
Thank you, Mr. Chairman, for giving us a second round here. And as you all know, Mr. Michel and Mr. Hempler, Director Cordray was in front of our committee yesterday, and I raised a concern with him about the Bureau's regulation on international remittances, and I shared with him a concern that was raised with me from a constituent, the Fort Knox Federal Credit Union. And as you can imagine, the Fort Knox Federal Credit Union serves many service members who are deployed overseas, and they simply want to be able to send some of their paycheck back home to their spouse while they're deployed. And because of the Bureau's overly burdensome regulation and the implementation of those rules, the credit union had to basically get out of the business, and that obviously was a huge inconvenience for those service members and their families. Director Cordray's excuse was that Congress made him do it, and that it was our fault that this was happening. And while, Mr. Hempler, you don't represent credit unions per se, but you all are observers of the Bureau, I just took a look at the statute, the Dodd-Frank Law, Section 1022, which actually requires the Bureau to look at cost-benefit analysis and to mitigate costs such as this. Does the Bureau have the discretion, does Director Cordray have the discretion to ease the regulatory burden on regulated parties so that these kinds of consequences do not occur? And by the way, I asked him, the credit union in question called him thinking that this was an unintended consequence. And they reported to me that Director Cordray himself told them, no, this was an intended consequence. Can you comment on that?
Sure. No, he absolutely has the discretion to go the other way. It's one of the bizarre things from my point of view. I understand what was going on in that environment when they passed Dodd-Frank, but from my perspective, you don't want either side of the aisle. You don't want to create an agency like this because you might find yourself in a situation where you're on the opposite end of what you just created. Even if the Trump administration doesn't fire Director Cordray, there will be a new director. If that's somebody like, just say, I don't know, Todd Zawicki from George Mason, he will have the discretion to reverse a lot of this stuff, just outright authority to do it and to not do anything else that he doesn't want to do.
Mr. Hempler, can you comment on Director Cordray's pointing the finger at Congress instead of looking at what the Bureau can do itself to ease the burden on regulated entities like this Fort Knox Credit Union that no longer can serve its deployed service members?
Thank you, Congressman. Yes, I can. I think one of the basic problems here when it comes to not only remittance, but also other consumer products, is that very few people, especially at the CFPB, but I would say even just as equally at some of the other federal regulators, have no experience in extending credit to consumers, have no experience in some of these products, be they a remittance product, be they an installment loan, be they a subprime vehicle finance loan because you're trying to extend credit to a college grad that needs to finance his car to get to his first job.
Well, I would just note, I mean, you know, the Bureau seems to be able to have the discretion to ban financial services and products. I don't know why it doesn't have the discretion to help service members deployed overseas send some of their paycheck back to their spouse back home. I think that's absurd. Mr. Baer, one final question. This idea of gold plating of U.S. standards, I mean, we believe, as the Financial Choice Act reflects, we believe that large, systemically important institutions should be required to maintain, or at least be incentivized to maintain, healthy levels of capital. But can you speak to the apparent need for the government to impose requirements that go well beyond anything that we impose on banks around the world, and the effect of this gold plating idea may have on the competitiveness of American banks as they compete in a global economy?
Sure. I think gold plating is generally referred to as where U.S. regulators go off to the Basel Committee or the FSB and negotiate an international standard, and then come back and dramatically increase the stringency of that requirement for U.S. banks and U.S. banks alone. I mean, the competitiveness aspect is difficult to tease out, certainly at a time when European banks particularly are in difficulties and U.S. banks are doing well. We may see that over time. I can't tell you I've seen research to demonstrate that right now. I think the bigger concern is simply the effect on economic growth, and in particular, certain types of lending as a result of higher standards than at least an international body thought was necessary. And that's true not only with respect to the ones that have been officially gold-plated, like the leverage ratio or the LCR, but if you think about the Federal Reserve CCAR stress test, there's a European stress test which bears no relation to it. So that's actually a whole construct that has no international parallel in any meaningful way, except perhaps in the United Kingdom. There are certainly benefits to U.S. banks that have accrued from being the best capitalized and the most rapidly recapitalized post-crisis. And I don't think anyone would dispute that. And it's helped them competitively in a lot of ways. But there are certainly areas where you see overlaps between these gold-plated rules. We talked about one earlier with respect to custody banks, where, and you also see with the way that they've imposed ring fencing on foreign banks operating in the United States. They're having real, if not competitive effects, real effects on the ability of those firms to serve U.S. customers, whether they be corporate or individual.
Thank you. Thank you. I yield back.
Gentleman yields back. I've got just a few follow-ups just to kind of clarify a few points very quickly here. Mr. Baer, you talked at length about the Community Reinvestment Act, and one of the things that I've seen, and you did a good job of explaining the act and some of the concerns, probably some reforms that need to be done. One of the things that I've seen is that the examiners now use this as a sort of a punitive way to sort of carrot and stick approach, where we'll hold the exam open until you do something over, keep you from being able to merge a bank until you put a facility over here. Is this something that you see as yourself, other places, either misusing some of these laws and leveraging them against for other activities, trying to micromanage the bank?
Absolutely, Mr. Chairman. It's not just the Community Reinvestment Act. It's why I focus so much on my testimony around the CAMELS requirements and those standards. And in a whole host of unwritten rules now that say, for example, if you have a consent order pending for any reason, even something unrelated to the kind of expansion you want to do, that effectively puts you in what the regulators now call the penalty box. And if you look at why there hasn't been more growth, be it branching, mergers, acquisition among, for example, mid-sized banks, that everyone expected would be growing, it's because many of them have been in the penalty box for years. Because there's another unwritten rule that if you get a consent order, you can't get out of it for generally at least 2 years and often more. And during that whole time, you're in the penalty box, whether you're making good progress or not. So, again, Congress never enacted any of these obstacles to expansion. In fact, if you look at the Bank Merger Act or the National Bank Act or the Bank Holding Company Act, there are explicit standards for when you should be allowed to expand. And yet, there are new invented rules that have come along over the past few years that have really stopped this in their tracks.
Yeah, the arbitrariness of their actions really is breathtaking sometimes. The bank that I referenced in my opening testimony is someone from my area, and they have a very unique product that they have in the bank. It's not illegal. They had it approved by the banking regulators, but it's a unique product. And as a result of that uniqueness, now that they want to sell the bank, the regulators are trying to get them to divest themselves of this product. Well, that's one of the reasons that the other banks want to purchase them, is because it's a money-generating activity that can help pay for the purchase of the bank. And yet, they've been holding this open now for 5 years to try and keep them from doing it. This is the kind of nonsense that's going on, and that's why this hearing is here today, to see how these rules are being used and abused. So thank you for your comment. With regards to the CAMELS rating, I'd like for you to just explain a little bit more of what your concerns are with that, and how would your suggestions for reworking it, because I think this is very important.
Sure. A CAMELS rating, and again, this was started in 1979 by the FFIC, which is sort of the umbrella group for the regulators when they examine. And it rates you according to capital asset quality, management, earnings, liquidity, and then the S for sensitivity to interest rate, particularly market risk, was added probably a decade or so later. The oddity is that when they adopted it, they had a series of subjective standards that examiners should look at in deciding whether you have good capital. Well, now, almost 40 years later, we have dozens of capital requirements that banks have to meet, and including the stress test for the larger institutions. And to the extent that you meet all of those, there really doesn't seem to be a very good argument that your rating should be anything other than 1. Same with liquidity, if you comply with the liquidity coverage ratio, which the regulators have explicitly designed to be a comprehensive look at the quality of your liquidity position. And in fact, examiners, and they frequently do not give you a 1 or even a 2 for those things, they don't engage in a robust discussion or analysis of why, notwithstanding the fact that you've met all the requirements that their agencies themselves have created, you can't get a good rating. And there's also another unofficial, unwritten rule that if you have a 3 for management, you can't have better than a 3 for composite. And of course, there are legal consequences in terms of your ability to expand if you have a 3 for either. Really what's happened over time as the CAMELS rating has sort of been divorced from financial condition because that's being taken care of by capital and liquidity requirements, it's really become a compliance rating system. And that's what drives your management rating, that's what drives your overall composite rating, and that's what really, if you think about what has made the examination process so much more draconian, subjective, and really in a lot of areas arbitrary, it's been that move away from CAMELS as a wholesale look at your financial condition to really a focus on your willingness to engage in compliance activities that the examiners want you to engage in.
Thank you, Mr. Baer. Mr. Michel, you talked a lot about the reorganization of these financial regulators, and one of the things in my discussions with a couple of the Fed presidents has been that they would like to see that all of the Fed presidents be on the Fed board instead of a rotating situation. For instance, if a Fed president is not on the board, that area of the country is not represented per se, as other areas are on and off. When the New York Fed has got their permanent position there, to me, there's a fairness issue there. Would you like to comment on that?
Sure, and the way that it's set up is definitely a relic of the founding of the Fed in early 1900s. And there's a lot of issues like that, but this is one where it really doesn't make any sense anymore not to have everybody rotate on and to give the New York Fed a special sort of place there, for various reasons. I think you could even make the argument that the West Coast District is completely is overly large now, based on obviously the way the population was when we started it. The Federal Open Market Committee conducts open market operations through a system that was created for the technology at that time, and we've outstripped that. So these are all issues that could easily be addressed. I think the New York Fed one seems to be, although New York Fed won't like it, a slam dunk in that it really doesn't make any sense anymore not to have everybody rotate on.
Thank you. With that, we want to conclude the hearing here. The title of the hearing today was Examination of the Federal Financial Regulatory System and Opportunities for Reform. And I've got a whole list of the different bills and laws and actions that you all have discussed today, and we're going to use this hearing as a predicate to go have some more hearings and do some bills and some things, and we certainly appreciate your testimony along that line. As a follow-up here, we didn't get a lot of testimony from the other side over here today, and some of our members had to leave early. So I'd like to allow a minute or so, no 5-minute testimony now. I've got a plane to catch too. But if each of you would like to take just a minute to either summarize something that you thought was important that you didn't get a chance to discuss, or respond to somebody else, or present a new idea that we didn't have here, I'd certainly entertain that opportunity. I'll give you that opportunity. So, Mr. Baer, if you'd like to start first, we'd certainly
Mr. Chairman, I think that the hearing's actually been quite good in doing a good survey of the procedural issues that we're now facing in banking. I think your anecdotes and some others were quite powerful in demonstrating how a breakdown in process actually makes a real difference to the way that banks are able to serve the community. I mean, and I also think it's an area that's really ripe for congressional oversight, because again, we're talking about unwritten rules that have no basis in law and have no basis in regulation. Sometimes they have basis in guidance, but often they don't even have basis in guidance. And so I think I guess maybe that's the one thing that we haven't focused a lot on, though, and I think someone alluded to it, is that we really now have regulation by guidance, regulation by enforcement. And I think all of that's why Congress needs to keep an eye on this and make sure that the regulators actually are running a transparent process, not just because it's fun to run a transparent process and it's fair, but because that actually makes for better regulation.
Very good. Thank you. Mr. Michel?
I'd just sort of dovetail on that. I think we focus a lot on CFPB and their discretion to do these things, and in some sense, that's you see that in other banking regulators. Not just in some sense, but you often see that. Everybody knows that the bank examiners come in and say something about too many loans in one area or another, and you have to stop doing it. And so this is a discretionary sort of process that's evolved. That I think you have a really good case to make for simplifying and fixing that problem by doing something like what you had in the Choice Act. It's an election. You can choose to go into a simpler regime. I think there's a lot of room to expand that. I know we didn't get to talk about that here, but I like where that is going.
Very good. Thank you, Mr. Michel. Mr. Garrity?
Thank you, Mr. Chairman, and thank you again for the opportunity to be here today. I think the most important theme that I would pick up in the testimony today is just the great diversity of our banking system. We talked today earlier about rural banks. I was looking at data yesterday. The average rural bank with $50 to $100 million in deposits earns about $1 million a year. At $10 billion, the average bank earns more like $120 million a year. So even within the community bank space, there's just tremendous diversity. And I think one of the major themes that needs to be focused on in any conversation about how to improve our financial regulatory system is about how do you simplify the burdens for the smallest banks in the system and not use those as a reason to roll back really important reforms for the largest and most complex institutions.
Great observation. Thank you, Mr. Garrity. Mr. Hempler?
Thank you, Mr. Chairman. I also want to thank you for holding this important hearing today. I think I would reiterate what some of my colleagues have already said in terms of the rural bank at $50 billion in deposits making $1 million. We have small finance companies that are struggling with the same compliance burden as JP Morgan Chase. We're talking about the difference between keeping the doors open and affordable access to credit and closing those doors because you just can't live under the burden as a small business. For example, in its supervisory process in the auto space, the CFPB issued a larger participant rule. They captured in their net 90% of the overall market. That goes well beyond the largest of the large, even the large, anybody that qualifies as large. They captured those folks, and what it means is that some of the small finance companies are not going to be able to extend access to credit to that single mom who needs a car to get to work.
Thank you, Mr. Hempler. And again, thank all of you for being here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for their witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, this hearing is adjourned.